Thank you very much. I know that just like an airline stewardess would say, is like, you could fly some other airlines, but I appreciate you taking the time to do this. So this is how to buy $1 million business without risking everything. And risking everything meaning like the landmines, wasting time, or just financially chasing garbage. So let's get going. All right. So total time, just doing an intro, 5 minutes. Part one, I'm going to talk about deal flow. That's about 12 minutes. Part two is deal review, about 12 minutes. Part three, deal financing. That is about 12 minutes also. And I'm going to open it up at the end for Q&A. And it should take a total about 45 minutes if you just listen to the presentation. All right, so here's my story. I bought a business. I like course businesses, online businesses, and the revenue disappeared. That's my first one. Well, actually, it's not my first one. I grew up in Wilcox, Arizona. My first one was buying a cow at an auction for $90 and selling it for $2,000 2 years later. They grow big, they grow fat, and they're really good beef. But that's actually my first one. But this one I'm talking about was an online business. It was a course business. I think I bought it from Website Closers, and revenue disappeared overnight because Yahoo changed its ad policies. Overnight meaning within a year's time. Man, I couldn't do anything to fix it. So that was my first exposure. I basically learned the hard way. I didn't quit. Then I bought and grew and sold a hearing aid e-commerce brand, probably to the second largest one out there based upon the number of hearing aids I sold and the revenue. It was like $7 million in revenue. And then I sold that through Empire Flippers. And I'll tell you, I owned that for about 6 years, and you learn a lot because everybody's going to go through a cycle up and down. I went through a down cycle where, again, Google went from to desktop to mobile on their ads. And where I used to bid on 13 spots, went to 4. So my cost per click went up almost 3.5 to 4 times. So my cost of acquisition went from like $100 to $400, and it made it unprofitable and almost killed my business. But I was able to turn around. I stuck to it, and then I fixed it. Outsourced everything and spent less time on it, and grew margins by just creating some videos, how-to videos, and then retargeting, and then optimize it. Totally possible. And then I put it on Empire Flippers to sell, and it sold in 72 hours, which had a call with the owner of Empire Flippers. Like, oh, should I have asked for more? And he goes, yeah, you never know. So along the way, I've actually raised and helped companies raise 50 million. I didn't do it all on my own. Raising capital is always part of a group effort. We also helped one of the companies that we worked with uplist to NASDAQ. We got stock for doing that. That was great. I actually worked on a $7 million consulting for equity deal. So a guy I used to be in software with a long time ago, known for 20 years. He said, hey, I'm looking for these kind of companies. I went out and looked for them, made the introduction. It was a $7 million deal, and I got $1 million in shares in an OTC stock. Unfortunately, it's not worth a lot right now, but it is, that does work. So in the last couple of years, I've interviewed over 150 deal makers, service providers, and I have learned a ton of information. The best, you can either do it or you can learn from others. And I learned from people that have done, 30 acquisitions, 100 acquisitions, sold 300 businesses, sold 150 HVAC companies. I love learning this. So you don't have to. And let me go on to the next one. And just in the last couple of years, I built Deal Flow System and the acquisition engine. It's to help first-time buyers avoid my mistakes and close deals. So here's why most buyers fail. And I've learned this over the last couple of years, and I fell into the trap myself. So one is they chase garbage. There are a lot of listings out there, whether you're going online, like online businesses, Website Closers, Quiet Light, or Empire Flippers, or FE International, or you're looking mostly for offline businesses, like Sunbelt or Transworld or First Choice or anything like that. They don't really know what a good business looks like because a business broker is a salesperson. It's a marketing person. So when you see something online, they're optimizing it to get you to click on it. And they're optimizing when you ask for the SIM, it looks great, right? The problem is if you're chasing garbage, you're wasting your time. And you've got to know what garbage is and a good deal is. The distinction between the two. All right. So no clue how to value it. So this all comes back to something I lean on. Now, I'm not saying you can't do this without a math degree, but I had an engineering degree a long time ago from NAU. I spent years and years in software. I also was working on getting a math degree at Plattsburgh a long time ago too. But I also spent about 6 years at Intuit looking at thousands of, income statements, cash flow statements, balance sheets. You have to know the language of business. The language of business is accounting. Warren Buffett said that. So you've got to know what a good deal looks like, what a bad deal looks like. Is the business using cash accounting? Is it using accrual accounting? Is it got a lot of debt on the business? What's the real cash flow of the business? You've got to know what a good deal looks at, because what you want to do is like, hey, that's a bad deal, move on. And the faster you do that, the faster you will find a good deal. Got to kick out the bad deals as fast as possible. And this all comes to can't get funded, right? And there's two parts of that, right? Do you have a 200 credit score, or you don't have any money saved in the bank? That's going to make it very, very difficult. But if you got a great credit score and you can get a loan, it's over 760, 40, whatever it is, SBA 7A rules, you should be able to get funded, right? But 90% of the cap stack for an acquisition SMB is going to come from an SBA, 70, 80, maybe up to there. So you got to find a good deal that the cash flow can support the debt. Now, debt service coverage ratio is very, very important. You have to know what a 2.0 debt service coverage ratio is, or a 1.5 or 1.25. Can you get this business funded? That means you have to know what the real cash flow is before you send this business over to underwriting in the SBA. You want to send good deals to them. If you don't, so basically, there's two parts to being qualified for this loan to buy a business. Like if you are a poor risk, you're not going to get funded. If it's a bad deal, you're not going to get funded. You got to make those two work together. All right. What you'll learn today: deal flow, deal review, and deal financing. So I want to show you how to find better deals. I want to show you how to know what to pursue versus what to avoid. And I want to show you how to use other people's money to buy a business. And that's where I created the acquisition engine. It's basically something I just created the last couple of years, kind of the branding, but it's a 3-part system. And I break it into 3 parts: deal flow, deal review, and deal financing. It's built for people, not PE guys, MBA grads, or people with a ton of money. So let's talk about deal flow first. Without deal flow, nothing else matters. So write that down. Without deal flow, nothing else matters. And most buyers chase bad deals, or not enough. Let me talk about like the bad deals. You've got to find a good deal that is cash flowing real well, and always target something with a 2.0 debt service coverage ratio. And what that means is the cash flow is twice as large as the debt. That gives you a margin of safety. Did you know that, like, if I said, oh yeah, SBA lender is going to do a 1.5, well, that means 67% of the cash flow is eaten up by debt. Some SBA lenders will say 1.25. That means 80% of cash flow is eaten up by debt. And I'll tell you what, the curve is real, which means once you buy a business, there's likely to be a downslope on that, because you lose people, you lose clients, or a black swan event comes in, and that is going to be painful. So you got to have a margin of safety. Or not enough. I have a number of students that, I say, you got to get your reps in, and they're out looking at 1 deal per week. That's not enough. I mean, it's going to take forever. You need to be looking at 4, 5, 10 deals a week to make this happen. And there's a couple of reasons for that. You've got to get your reps in, but it also helps you understand what a good deal versus a bad deal is. So you have to get enough of those reps in to get good at looking at what good deals in, so you spend your time on the best opportunities. All right. Why 90% of deals aren't worth pursuing. If you go to Biz Buy Sell right now and you look at all these deals on it, you spend a day looking at them, 90% won't be funded because they're just crap. I mean, the broker's trying to get you to come to see them, look at them, and create this like, oh my God, I can make this work, which they do a lot of the time. But a lot of these just can't support the acquisition if you're using SBA 7A. You need to be looking at deals that have a lot of cash flow. And once you do find something with cash flow, you have to jump on it as fast as possible. Money loves momentum. And you have to find it as soon as you start swiping through all these bad deal, you find a good deal. You have to have your cap stack ready. You have your investors ready. You have your due diligence ready. You have to have your attorneys ready, your CPA, if they're going to do some like light due diligence, to jump on this as fast as possible. All right. 2 types of deal flow in this. Remember, I wanted to go back to that. Without deal flow, nothing else matters. There is on market, a biz buy sell, brokers, listing platforms, a lot of AIs doing that today. But on market, I want to tell you about why everybody, if you're first time business buyer, should start with on market. There's 3 conditions that are met. Number 1, they have a motivated seller, which means the guy or woman who's selling the business said, I'm done, I'm out, I'm going to go sign a contract and say, I'm going to be leaving this business on however long it takes to sell, usually within 6 months to a year. Number 2, they have a starting price. So if the broker's been in the business for long enough and they want to sell the business, they'll have a rational price. That's a starting price. Doesn't mean that's what you're going to pay. But if it is, on the other turn, a good deal, you're probably going to have your offer will be asking price if they're a good broker. I mean, I saw a deal the other day that was a SaaS business, only did $1 million in EBITDA, and it's been around for 15 years, hasn't grown because they're a SaaS business for jewelries. The market's tapped. The guy wanted 12 million, 12x for it. That's too rich for my blood. Passing on that. And number 3, the broker doesn't work for you, but they're not working against you. They're going to get all the financial records together in one spot, which means you can go, hey, I signed the NDA, I got the SIM, I'm interested in the business, send me the financials. Or if they load the tax returns, the 1120s up. So all of that is ready to go. That's on an on-market deal, and those deals will happen faster. You just have to shift through all the bad deals, and to find a good deal. And then there's off-market. There's a lot of ways to do off-market. You can do for online businesses like IT firms or e-commerce companies or something like that. You can go to LinkedIn outreach and do that, or you can get a list from Reference USA and start emailing, calling. Or the other way is centers of influence. Now, centers of influence are like attorneys, health managers, or accountants, or your pastor, or preachers, or, friends next door, or somebody else on the business, or somebody in Kiwanis or Rotary, or whatever group it is, somebody that can refer you. Now, the big difference between on-market and off-market is like, if I took a seed, an apple seed, and I put it in a great, rich environment on the back. I don't expect to go out the next day and pick fruit like an apple and eat it. It just takes a long time. And a lot of the times, if you go to these wealth managers, and you just can't go to somebody you don't know, like an attorney or accountant, and go, hey, you know what? Do you know anybody who's trying to sell their business? They're not going to give you that name. I mean, you haven't filled their book with goodwill yet. Now, if you've known them for 5 years and you're on the golf course and you go, hey, you know what? Look, you ever know somebody selling their business? Let me know. And you've done business with them. They've done business with your friend. They know each other. They might give that up. But building this off-market outreach takes time. So set your expectations. All right, how to build a pipeline. Now, let me go back to that. So how to build a pipeline. You start with on-market deal flow. And what you're going to find is, oh, gosh, there's a whole bunch of business on Gotsman or Loop or Biz Buy Sell or American Health. There's a whole bunch of stuff that I can go find, and I'm going to start sending out emails. And you're going up and up and up. Great. All of a sudden, there's not a lot of deals, right? It's just the way it goes. So you have to supplant that with some off-market outreach. Start reaching out on LinkedIn. Start reaching out on X. Start reaching out on Facebook. Start reaching out locally and letting people know what you're going to do, because that's going to come around up and down on your deal flow. Let me admit this person in. All right. And that's your pipeline. Sometimes what's going to happen is there's just not going to be enough online market deal flow. Maybe you will get something and it looks great. You put an offer into it, and then they said all of a sudden you go, oh, I lost that to somebody else's LOI. Then you go, pass on that one, move on. You move on from that one. But what happens is maybe a month or 2 months down the line, the person that won that LOI couldn't raise the financing or found something in DD that he didn't like. And then they said, hey, you're the first on the list. Are you still interested in the business? That will happen to you. So you just got to keep looking at 5 to 10 deals a week, start your off market to build and build and build. This is really good. Now, if you've ever been in sales or marketing, those skills will really help in deal flow, because without deal flow, nothing else matters. Tom was like this. Tom really didn't know what a good deal flow looked at. And I said, hey, man, first of all, we've got to create, a criteria, what you want to do and how much you want to earn. And we started looking at all these on-market companies for security companies, physical security companies. And he was able to, after the 14th deal, 14th thing he sent me on a sim, I said, hey, this is a good deal. Let's take a look at it. Let's get the financials. That's the first thing to do. The second thing he was like, okay, let's look at the tax returns, and then you can make an offer. So deal flow. Without deal flow, nothing else matters. The right deals are out there, but only if you build deal flow. All right. The second acquisition engine is deal review, and why most people waste time doing diligence on bad deals. What a fundable deals actually look like, and the report card, what are the 3 financial statements you need. So the deal let me go back to this. So what a fundable deal actually looks like. That's where you get all the financial report cards. You like it. And I'm going to give you a perfect example of this. I have a student, she's looking at a med spa in Florida, and the broker sent a sim and it said $330,000 on it, SDE. Well, we said, okay, that looks great. That's something she wants to do. So we asked for the QuickBooks files. QuickBooks files were a little bit messy. They weren't even in balance. We had to be skeptical about those. And the income was only about $175,000. Okay, something's not off here. So we said, send them the 1120s. The 1120s tax returns were even lower, like $100,000. But you remember, if tax returns are, the objective of tax returns is reduce your taxable income. Take as many tax deductions as possible because you don't want to send it to the government. It does a good job of wasting your money. So we said, look, all of these 3 things are different. Please send your bank statements. Just 12, just to give it an idea. So we took the bank statements like January to February, every month, every cash going in, cash going out. And we analyzed every little line item expense and deposit to the business. And we saw that she was using her business account for personal transactions up to like major amount of money. So we determined the business is actually throwing off $570,000 of real cash flow. And we learned that she didn't have a personal bank account. So that kind of verified it. We'd have to verify that with the broker said that, but we need to trust but verify. Trust but verify. Anyway, there was a great business. We put an LOI on it, but we lost it out at all cash offer. By the way, that will happen. You are going to lose good deals because somebody else saw that it was a good deal. All right. So 3 things to look out for: backs and normalized cash flow. You're going to see a lot on these sims where it says SDE, which is seller discretionary earnings. And a lot of these, I would say a lot of these brokers are throwing in add backs. They say, you know what? This expense, we're going to put an add back, and that goes back into cash flow. Well, not actually. You have to know what a good add back is or legitimate add back is and what it's not. The rule of thumb is if the expense is going to be there next year, it is not an add back, right? If the expense is going to be there next year, it is not a legitimate add back. What they're trying to do is increase that SDE and then put the multiple on the SDE and give it a bigger price. Your job is to find out what the real normalized cash flow is. Let me give you another example. An add back, depreciation. Gosh, there's a lot of people that add depreciation in the business. I've seen $100,000 added depreciation. Well, if you're an accountant, or you don't have to be an accountant, but I'm telling you right now, depreciation is a non-cash event. It helps with your tax deductions, but your tax deductions are going to be different than the seller's tax deductions. If you buy the business, your tax depreciation schedule is going to completely reset, and they may be different. So depreciation is not a bundle of money that goes back into the pool that the SBA loan can see as cash flow. That is one thing you have to check for, especially with brokers. Some brokers are real estate agents, and they don't really know what a legitimate add back or what adds to cash flow and what doesn't. Debt versus real SDE. So what I've learned is a lot of these brokers will send out income statements, and the income statements, the net profit will look great, or the EBITDA will look great. However, your job is to see how clean the books are. Clean the books are means they are using accrual accounting versus cash accounting. Cash accounting can be used, but it's going to make the income statement look kind of ugly sometimes. There's going to be up and down, losing money, some net. You can't, according to the IRS, use a cash accounting if you have inventory you're selling. So any business that has inventory should be using accrual accounting. Now, are the books balanced? How do we know that? So the books are balanced, which means equity equals assets minus liabilities. And that will show up if you have an income statement and a cash flow statement. A balance sheet. On the balance sheet, the net income will be the same number as the net income on the income statement. If the books are not balanced, you have to be skeptical about how good they are tracking their expenses. And what you want to look on is that balance sheet. And I think the balance sheet tells more about the business than the income statement. The balance sheet tells you how well they are turning assets into cash flow, how well they're taking those assets and converting them to cash flow. And if they're taking any debt, because if you get the balance sheet and you say, oh, the net income's great, everything looks great, but they only have $5,000 in their cash account and they have a lot of debt, no SBA lender is going to lend on that, right? You got to know what the debt to equity ratio is. An SBA underwriter will do that. You don't want to send that bad deal to them because they're just, it's not enough. And that's wasting time going down that road. All right, red flags. This is what the SBA looks for, customer concentration. They don't like any customer concentration or more than 40%, I believe. CapEx and declining revenue. I've seen a lot of businesses where it's declining year to year to year. I mean, what's the likelihood if you're going to take out a 10-year loan that it's going to keep going and down? Most bankers are very conservative, and they can only giving you a 10-year loan based upon what the business used to be doing. They don't know whether you're, are good about doing turnarounds or not. Use somebody else's money, but not the SBA's banking money. They're very, very conservative. Yes, Kyle Hanna. Yeah. 40%. All right. So next thing, tools, AI. Every single student of mine, I tell them to use AI. It is so powerful. It's like having a JP Morgan or BlackRock intern doing all your work for you. It is your MBA rocket science kind of deal. I love you can take the sim and you upload it to ChatGPT. You want to anonymize that. People say, hey, anonymize it. Make sure you don't know the names. But you could take the sim, upload that, and it'll analyze the deal. Tell it, hey, what's the normal valuation for this type of business, like HVAC companies in Texas? Or what's the debt service coverage ratio for this business? Or what's the, what's the real number valuation based upon what this is? Also, you can upload the financial report cards, the income statement, cash flow statement, and the balance sheet. And of course, anonymize this stuff, but he goes, okay, analyze this business. What's the debt service coverage ratio for the asking price? What's the real valuation for this? Use AI to do this quicker for you. I used to have group meetings with Pastor Pursue. People would come to them, and I'd have to be doing the whole thing. Now I teach all my students, go to the upload, make sure you come back and use AI to analyze this deal. And when we are coming to Pastor Pursue, I need to see the debt service coverage ratio, the working capital, risk to the business, the SWOT, strength, weaknesses, opportunities, threats, analyze it. If I don't have any experience or lack experience, tell me what the risks are. AI will do that for you. And it also give you a deal scorecard if you're interested. So for deal review, everybody should be using AI going forward. I just want to get a show of hands. Are you using AI today? Just kind of put it in the chat and go, yeah, I am. Or no, didn't think about it. Jacqueline, of course you are. Great. All right, so this is another story about Sam. We looked at some books on a company we were looking at. She's one of my students, and it was the books were kind of ugly. It was a e-commerce deal selling hair growth stuff for Black Americans, African Americans, very niche product. She's part Black, but half Black because her dad's from Morocco. And we looked at this like, oh my God, there's a lot of cash on the account. It's like $1 million, right? And then there's also the net income was like $2 million. Like, this is a great deal, but the books were very ugly. And she was also, you could tell a lot about the income statement was she was like inflating cost of stuff that normally weren't in, should be. Like she spent $60,000 on an accountant. Well, usually on an SMB that size, maybe it's 5,000, maybe it's 15. It's not 60,000. So she's trying to maximize deductions so she doesn't pay any more income tax. And she keeps more of her money. But that thing had great cash flow. We put an offer on it. And this one, we lost it because somebody got in her ear and said, hey, you got a great deal. The likelihood of you recreating this in some future is probably not going to happen. We lost that deal, but it was a great, great deal. And the only tell a great deal is being able to know what accounting is. Like accounting is the language of business. All right, so let's go on to the next one. Hold on. And you can't buy everybody's business, but you can get really good at spotting the right ones. And when you do spot the right ones, go all in on it. All in. You swing for the fences. If it's a great pitch, swing for the fences. All right. The next engine is deal financing. All right. The myth of no money down. You know, click the wrong button. Look, I'm not the no money down guy. There are other guys out there on the internet. I'm not that guy. I've interviewed probably 160 entrepreneurs now, and only one guy uses no money down for their first time business. That is just not really possible. You've got to look at thousands and thousands of businesses to be able to do that. I'm talking about smart living. Oh, by the way, you can use no money down after your first business. I have one of my guests, Brian Beers. He owns like 35 Midas franchises, and every business he buys down, he goes to him and goes like, I'll pay you seller financed deal. But that's because he is now the bank and his cash position is much, much better. He's the bank. I just talk about smart leverage, like getting your personal finances together with the personal financial statement, finding a great business, getting a loan, using the SBA. There is no other type of entrepreneurial opportunity to use SBA and get a loan to buy a business 2-3 times more than what you're worth in the world. Canada doesn't do it. Europe doesn't do it. Nobody else does it. 3 ways people actually finance acquisitions. That's the SBA loans. That's your checklist. Seller financing. Now, SBA changes all the time, and you have to check how much seller finance you could get done with that. Sometimes it's 10%, sometimes 15%, sometimes it's like 20%. And investor capital, even without a huge network. So a lot of today, there's a lot of opportunity to use social media to go raise the capital to purchase an SMB that if you don't have $300,000 in a HELOC or your real estate or your 401 cash in it, my recommendation is that you don't cash everything out. It's like, I wouldn't want to see you on that poker card table going, oh, I'm all in, and push it all in, because I guarantee you, back to that J curve, it is a real thing, which means if you buy a business, it's likely to go down because of a number of things, new owner, losing customers, industry changes, whatever it is. And then you have to tap into some other capital source to pay these people. My suggestion is using outside investor capital. There's a lot of groups, like I'm an advisor over at SMB Investor Network. I'm friends with the folks at Capital Pad. I am friends with the guys at SMB Invest, and I've done some business over at Main Shares. These are all networks where you say, hey, I've got 50,000, but I need another 250,000 to close this. I'm going to go to one of these networks and do this. And you could always do this yourself through social media. Got a big channel. That's a deal. But most of these business SBA or SBA loans, probably about 70, 80 to 90%. Some seller financing, great, and investor capital. What lenders look for, and this is becoming more and more important to understand, before you take this to an underwriter, is the debt service coverage ratio. That's your Warren Buffett margin of safety, right? I want more cash flow than I'm paying in debt. There are a lot of SBA lenders will say, oh, we'll do 1.5. We'll do 1.25. Remember, 1.5 is 66% of your cash flow eaten up by debt. 7%. 1.25, I've seen people do. There's some SBA lenders, and that is 80% of your cash flow. That scares me to death. 10 years of a loan where 80% of your cash flow is eaten up by debt. I wouldn't recommend doing it. You got to look for trends. You know, if you're looking for an online business, this is very interesting because I listen to a lot of podcasts like My First Millionaire. Those guys, Sam Parr and Sean, you know, they had a guy on there and he goes, you know, there's a couple things just going to go away with AI. Ghostwriters, where's that going? That's not going anywhere. I wouldn't buy a business with ghostwriting. You know what else is going? Probably some digital marketing agencies that make money on doing Facebook ads, because Mark Zuckerberg just said that he's going to completely revamp Facebook where anybody can put money in and AI will do the rest for you. All that your digital marketing agency was doing, like the creatives, the ad spend, the audience, everything, he's going to create that application to do it for you. So watch out for that. What was the other thing he talked about? Oh, CRM systems. He goes, this guest on My First Millionaire said that CRM systems, what AI is going to be able to do, maybe Delphi does this or maybe ChatGPT. And if your system's already in there, to just say, hey, give me the top 10 customers I should focus on this week. Boom, there's your CRM system. So look for trends. Where's that going? The reason, you know, Heather Anderson from Vicio, or Lisa Force from what's that? I can't remember the bank she works with. But all these people that love the service-based businesses like HVAC, plumbing, because they're not going away. The AI may help them in leads, may help them in the back end, it may help them in some admin, but somebody still needs to get on the roof and fix an air conditioning. Look for taxes. It's great to have, a lawyer coming in there and doing a UCI code and checking to see if they owed any taxes in arrears. You can go pay for that yourself, or you can get an attorney to do it. But you got to check to see if somebody they're paying their taxes. And experience. A lot of these, I have a number of students and where I just have to say no, where they want to buy a business because they're desperate and the financials look good, the SDE looks good, the cash flow throwing off looks good, but they have zero experience in it. And I go, and I tell them, they're not going to sell to you because you're going to kill the business. You don't know what makes the bell ring. Don't even take it to a deal. This is another subjective no. You have to have experience in the industry. Just recently, I have another student. He's in banking and wealth management, and he wants to buy a business and a side to kind of provide for his future, but he's looking at businesses where he has no digital marketing experience. And some of these businesses he was looking on Quiet Liar, online businesses that require digital marketing, mainly like, how do I go get customers online and convert them into, well, how do I go get prospects and convert them into customers? You're going to do that. You spend money on Google or LinkedIn or Facebook or Instagram or TikTok. If you don't have any experience in doing that, seller's not going to teach you. You got to be able to know how to do that. All right. Next up on deal financing. Simple cap stack. It's usually about debt is usually 70, 80% of the deal. Seller notes, 10%. And then you bring in 5 to 10% equity. That's usually a pretty good deal or a cap stack for an SBA SMB acquisition. All right. So this is a little story about Henry. Now, I'm not saying anybody do this, but Henry came to me. He's a veteran, and we talked about how to raise capital. And when you go out and try to raise $200,000, like, hey, I want to buy a business. It's $3 million. I need 10% down, but I only have $50,000. You have to look at raising capital as casting a wide net. I mean, instead of going fishing with just a pole, you're throwing a whole big net out there and cast a wide net, because you're going to talk to a lot of people, see if they're interested in this deal. And you better have a good deal before you send it to an investor and say, would you be interested in putting $50,000, $100,000 into this? And that's what we did for Henry. I introduced him a lot of people. I got a good social network. I'm doing that podcast. People know who I am. It opens the doors, but you got to talk to a lot of people, because you're going to hear a lot of no's. You're also going to get to a lot of the next step, and they'll go, I'll do it. But when it comes down to the day they write the check, they're not there. You can't find them, or their capital's committed for something else, or they got in trouble, or whatever it is. You have to have enough of those people to close that gap. And that's just being in sales really helps if you've ever done that. All right. Common mistakes raising too late. Now, my suggestion is a lot of people are going out there and looking for deals, and they're finding a good deal and they're putting an LOI on it. And then they're waiting. You got 90 days to do all your DD on this. And they're 60 days in. It goes, oh, I still need to raise $75,000. That's too late. I can't do anything about that. I could put some notes out of that, but by the time, some of my investors look at it, it's just not a time to make a decision. And I'm talking about SMB Investor Network, Capital Bad, SMB Invest, and Main Shares. It's just not enough time. So if you find a good deal, and the moment you sign that LOI and you need to raise money, you should already be talking to somebody that could help you raise the money. Also, credibility package, that's kind of like your pitch deck and making sure you have a good deal and making sure you're the right jockey to get on this horse. And the unclear pitch, meaning, how do they make money? These investors, you're going to them for $100,000, you are going to need to show them how they're going to make it. Is there a step up? Meaning, if they put in $100,000 now, what do they get back? It could be 1.5 or 2, meaning they get $150,000 or $200,000. Is there a dividend? Now, SBA just ruled you can't have dividends for 10 years until the SBA loan is paid back. So SBA changes all the time. And most of these people that are credit investors are wealthy enough and sophisticated enough, know what those numbers are, like multiple on invested capital, step up, dividends, etc. So have all that ready to go if you need extra cash and raise the financing. All right. But I just want to say, it's not in your bank account. It's about your structure and the story and your resourcefulness. All right. What do you do next? I don't know what time am I in here. Let me get my phone. 1 second. It's 9:45. Wow, that was 45 minutes. So this is no hard sell. You don't have to do anything. There's a 5-minute business buyer readiness score. I'm going to look at all areas, especially personal financial statement, like, your interest levels, your industry, nothing to it. I'll give you a personal analysis. That's at that address right there. You get my ebook, Deal Flow System and ebook. That's basically showing what the acquisition is, going into great detail about deal flow, deal review, and deal financing, the 3 engines that run a campaign. Book a 30-minute strategy call. I'll put the link in there. I use TidyCal, or get the course. It's just a self-paced course. It's everything I've created on how to find a business. That's $197. That's it. I am going to open it up for questions and stop sharing. Does everybody else got that? All right. Stop share. Okay. Let's open up for questions. Kyle Hanna accounts for 40% more. Yeah, most of the time it's 40%. Heather Anderson, she does a lot of loans. She's done over $500 million on loans. They don't like anything more. Now, there's some industries where you buy where that may be an exception. Like if I was buying a GovCon business where 90% of my revenue comes from the government, but they're going to look at when that contract expires, and when it if it expires in a year, not going to do it. If it expires in 4 or 5 years, great. And O&G, oil and gas. Usually 99% of your revenue comes from one customer, which could be Shell or Phillips or somebody else. So you have to look at the business, but you also have to find the right SBA lender. Heather will not do an O&G or GovCon. She just doesn't like that. Yes, reviews. Has anyone used AI to recommend an optimal cap stack, debt, seller, finance, equity, achieve cash flow? Yeah. I mean, you work backwards on this. I mean, you basically have an intern with an advanced, finance MBA degree, and just tell them, what is this business worth if I need to maintain a 2.0 debt service coverage ratio? Work backwards. Ask the question and then work backwards. Scott, did that help? Did Dan answer the question? Scott's still with me. Oh, there he is. Yeah. All right, we'll go back to that. Can a seller's note cover the down payment on SBA? Now, that used to be the policy, but the SOP just changed June 1st. So verify that. It used to be yes. A lot of things changed around the equity. It used to be like last year, the seller can keep equity and basically do a rollover, which is like PE loves to do. And they don't want that anymore, but they want the seller to do a seller note, kind of stick around, at least help and be an advisor. What are the options for non-recourse debt or cap structures to avoid pickup? Look, there are not a lot out there. I mean, commercial loans, you either have to go smaller and get it through a kind of a network, those other individuals, or you have to go larger to start doing commercial loans with bigger banks, which means a bigger deal so that you can avoid that. But this whole range between $500,000 and $5 million is SMB. There's just not a lot of ways to avoid that personal guarantee. Frankly, this is why it's so important. I'm 63, and I guarantee you, my wife says, you take another personal guarantee, I'm going to divorce you. It's just like, that's very scary. We don't do that at my age, and our asset base right now just wouldn't do it. I would buy bigger or buy smaller, all cash, or depends on what that kind of business looks like. All right. You guys, everybody can go off mute and ask a question if you want. We got about another 10 more minutes.
So John, where are you seeing like kind of the sweet spots right now and like deal size for kind of self-funded searchers? Is it, private equities kind of seem to be moving down below that 750 mark into the fives and stuff, or the family funds and stuff like that. So almost everything I've put LOIs on, with the asking, they're asking 3, 4, 5x. I can't seem to get anything to cash flow with interest rates and et cetera below like 2.4 to 2.6. And it's just not working out. Is there kind of a sweet spot that you're seeing, maybe 350 to 550, or is it?
It's going to like 500 and a little bit below that, 250. Okay. I know that these micro cap PE funds are looking at smaller businesses because it's too expensive, and the capital just required to go get these bigger deals is just a different kind of individual, and they can make deals happen faster, right? Because they got more capital to work with. They could provide their financial statement and go, hey man, we got $7 million in the bank. And when the broker sees that, they go, okay, this is a real buyer. Versus a guy that, well, I only have $50,000. I got to get approved and go through underwriting with the SBA. And then we're going to go through kind of light due diligence. And this all happens in 90 days. Where a private equity fund and go, we'll do it in 30 days, close in 45. Yeah.
Next question. Are you going to introduce your partner back there behind you?
Oh, that's Turbo.
Turbo just walked
Turbo is 12 years old and moves a little slow in 108-degree weather. Yeah, he's a good boy. Are you
also seeing any industries that are, I see that whole service, HVAC, all that stuff kind of overplayed now. It's, especially in my area in Southern California, there's a million of those trucks running around. Are there industries you see that are kind of flying under the radar a little bit? Or are they all kind of more niche? Is it better to go a little bit more niche, you think, these days?
Yeah, right. The HVAC, it's I just did an interview with a guy that sold 160 HVAC companies as a business broker, and he's like selling 3 or 4 a week. It feels
Patrick
like
Lang?
Yes, Patrick Lang. Holy crap! And I was like,
yeah,
he's a machine. And too many people are chasing those because it's reoccurring revenue and it's not going away, and AI is not going to attack it, right? Yeah. So you got to really go down like who supports the HVAC. One of the industries that I was looking at, medical billing, that's pretty cool, very profitable. It doesn't require any certifications or contractor's license kind of stuff. I had another student looking at cleaning the filters from restaurant businesses. That is kind of like reoccurring revenue. Now, it may work better in bigger cities like New York City because the city forces you to get them cleaned 2, 3, 4 times a year, but it's hard to get in. Somebody doesn't want to sell it because it's, reoccurring. I do have, some other kind of businesses, like very niche businesses, like the Anytime Fitness business, but it's been difficult to find one that's profitable, that does a good job of keeping cash flow. Right now it's about niching this stuff down.
Yeah, I think so.
Yeah. All right. Anybody else? Cool. Somebody's going to ask a question. All right. Tyler, Jacqueline, John, Melman. Spelled your name right. Kyle, Hannah, Paul, Huberg. Hey, what's going on, Paul? Zach, Joel, Wade, and Scott. Yeah. Look, one of the deals is you just got to get your reps in. Some people, it may take longer to find the right deal, but you just don't quit. Don't quit. Keep moving through the deals. Find a good deal. Have your cap stack and your service partners ready to go and attack it. The best you can do is, focus your eye on the ball and take a swing. You're not going to hit everything. And sometimes you might pop out, foul out, whatever, but just keep going. At some point, if you don't quit, it will happen. That's the kind of passing advice I can offer you. And make sure you go get some of my stuff or let me know how I can help. So we're up on an hour or 5 minutes. One last chance for questions, then I'm closing off. I will be offering this recording in a little bit. Hopefully that was helpful. All right. Nobody else?
So John, as part of
Yeah.
your course, you guys go through like a lot of deal analysis?
Yeah, every Monday it's 2 to 3 hours, and you bring the deals and we'll review them. Well, I'll tell you if it's a good deal, a bad deal, or get your LOI ASAP.
Okay.
Right? You just gotta. The more deals you look at, the more deals you say no to, the more LOIs. At some point, somebody's going to say, yes, I'm going to do it. Yes.
It's kind of like my dating is when I was younger.
It is like that. Thank God they had come with online dating. It was a lot harder when you had to go face to face.
Yeah.
Yeah.
All right.
You got to get your numbers in, get your reps in, and don't quit.
John, thanks a bunch.
Yeah, man. Hopefully that helps, whatever you guys are trying to do, Tyler and Kyle. And yeah, every Monday we have the Pass or Pursue meeting with 2 hours. And sometimes, somebody will bring an IT company, and I'll have an IT guy on the line or a real estate guy on the line and go, hey, you need to do this. You need to do what this looks for. And, or I'll put you in touch with that. I'll put you in touch with, capital investment or service providers, the best ones, whatever. Cool. All right, guys, it is 9:57, and I really appreciate everybody showing up, and I'll be doing more of these, and hopefully this has helpful. Get you started. All right, Scott, see ya. Bye, guys.
All right.
Thanks, John.